All right. I think we're at the time to start. Thank you all for joining us for this month's Coffee Talk session. My name is Sean O'Brien, and I'm pleased as always to be joined by Steve Huntington. Steve, do you want to go ahead and introduce yourself?
Yeah, thanks again, everyone, for joining us today. I'm Director of Analytics here at Quick Analytics. I spent my entire career working with community financial institutions on a broad range of topics, from strategic planning and M&A and capital planning to model design and maintenance. And I've been working with Sean and the Quick Rate team here for about a decade or so.
Awesome. And welcome you back for another month's session is Paul Allen. Paul is with the CPA firm Saltmarsh. Paul, thank you for joining us. And would you like to introduce yourself?
Just glad to be here, Sean. Thank you, Sean and Steve, for inviting me along. I work in Saltmarsh's FI practice, and it's been our honor for almost 80 years to work with financial institutions, and certainly CECL implementation is one of the bigger challenges that we had to work through. So glad to be here. Happy to help in any way I can.
Awesome. Thanks, Paul. I really appreciate it. Your perspective is always welcomed. It brings our biggest numbers in attendance. So thank you very much for being here today and being a friend to us. All right. So just a reminder, I suspect, everyone remembers, but we will, in order to, address all your questions today, if you can use the QA box or the chat feature, we will take those. Hopefully we'll make sure we get through them all. Just a reminder, we will send out a link to today's presentation along with the slide deck. So all of that will come to you in an email once we have it put together for you. We thought, since it was pretty well received last month, to start with just a few polling questions. We're going to cross our fingers and hold our breath that I can do this properly. But the first one we're going to launch is a day one question. Was your day one adjustment higher, lower, or roughly the same as your current ALLL? So we'll just give this a few seconds to get started.
That should be showing up in a pop-up window, a separate pop-up window. If you don't see it, look all around your desktop for another little mini window that's got this question in it.
Thank you, Steve. Always a good reminder for those of you using multiple screens. So like I said, just give this another 15 seconds or so. And
my office looks like the New York Stock Exchange. I got monitors all over the place.
All right, we will go ahead and end this one. So I'm going to share the results. 63% had a higher, 12% were lower, 26%. Actually, that makes 101, but close enough to keep it the same. So again, we will include the results of the polling questions as well. So thank you for participating in that first one. Let me go back to the next question then. The second question is, has your CECL process been reviewed yet by an auditor / examiner? Again, we'll give this about 30 to 45 seconds. Appreciate everyone taking a second to offer. Okay, fantastic. 3 out of 4 of you have not yet had it reviewed, so that's interesting. But thanks again for sharing that feedback. And again, we'll keep moving on. Whoops, let me stop sharing that. Next up, and it's really kind of a two-part question. As you prepare for the first quarter, what, if anything, concerns you the most? One single choice. We'll have a multiple choice here later, but I think a couple things we certainly, as we go through this year and think about future Coffee Talk presentations, recognizing there will be an evolutionary process to this, we want to make sure that we maybe dive into some of these a little bit deeper than maybe we have in the past, as we've just worked on and focus on implementation, but I think some of these might warrant further discussions as we go on through the year. And so this will help us prepare and formulate, future topics for our coffee talks or areas to focus on. So thank you all very much for, again, sharing your thoughts on this. We'll give it just another few seconds. And we'll end that one. Looks like the most popular topics, again, are kind of Q factors, the WARM calculation itself, and third-party acceptance. So again, thank you for sharing just a couple of more. So thank you for your patience and playing along with us this morning. Questions? Do you have any questions regarding the required numbers and how those reserves should be reported on the call report? So just a yes or no question here. Again, we touched on this a little bit last week in the presentation we did. We will have some slides on it here again today. But again, we want to make sure as we get ready here for the first quarter, we're all ready to go. Okay, so thank you for sharing that. About 2/3 of you have some questions and need clarification, so we will touch on that here this morning. And then certainly always know you can reach out to us. And so the final question is, and again, this will help us shape future presentations, and here you can answer more than once, but please check all that apply, select the areas where you would like us to provide more information or guidance as we move forward here. So this one,
I don't know if that's going to allow them to pick more than one. It says click all that apply, but then it says single choice. So I don't know if they'll actually be able to pick more than one or not.
Gotcha. All right. Well, we'll see.
We'll find out.
So pick the biggest one, I guess. Huh?
Yeah, exactly. Exactly. Okay. All right, we'll just give us a few more seconds. A few people are still clicking, I can see. All right, I think we're there. So these, again, the Q factors, the validation expectations, WARM calculations are really our three most popular areas. So again, thank you all very much for sharing that information. We appreciate it. And again, we'll share those results with you as well. So before we get going, I know last week or a couple weeks ago, I guess now, we did a quick presentation on some of the adjustments we made. Again, our apologies for not communicating those more clearly, but we did want to make sure everybody they're establishing those new reserve accounts appropriately, and we're presenting that to you in what we feel like is the appropriate way. But Steve, go ahead and just share any comments or thoughts you have on the existing changes and enhancement, but what also may be coming here. Shortly.
Yeah, I don't want to freak anybody out. These aren't all completely new. Most of these, if you've been following along with us and coming to our coffee talks and using the tool, you're probably mostly aware of all these enhancements that have been done over the past few months. But most notably, couple things we're working on currently that will be available in the future is some additional flexibility in extending some look back periods. If you wanted to do a little bit different math between the WARMs and the look back periods, that's going to be a future option that'll give you some more flexibility. And also we're going to be adding some additional customization options or flexibility when it comes to analyzing peer data. As we know right now, the peer data can be a little bit hit or miss sometimes because it depends on the size of your peer group, and it depends on what types of loans most of the credit unions in your peer group tend to have more or less of. That kind of defines the universe of peer data. And if some peers have some really high or really low numbers, it can shift a small peer group kind of one way or the other to make the data more helpful or relevant, or maybe less helpful or relevant. So we're working on ways to kind of improve that, so you can look at peer data in a more flexible way down the road.
Fantastic. So we got a question in already. as a credit union greater than 100 million with a very simple balance sheet, would it be best to take the allowance / adjustment as balance sheet hit all in one and then work / adjust the WARM to tie back to the ALLL? I don't think so. I mean, I think you want to establish what your WARMs are and see where everything is, if I'm understanding the question right.
I'm not exactly understanding the question, right? The first
Yeah, I
half of the
don't either.
question, you know, whether it's best in a vacuum to if you know that you have a shortfall or a surplus, is it best to do a day one adjustment to take it all now or to trickle over time? And I think Paul would probably speak to it. You should be taking it now. If you calculate now, this is what you need. Now is when you need to make the adjustment. But I'll let him speak to that. For the second part, working and adjusting the WARM to tie back to the ALLL. I'm not sure I understand the question exactly, but I don't think you should be doing anything to adjust to tie back to an older methodology that we're no longer using. The WARMs
It
are
should be less than
mathematical.
100 million. Yeah. Yeah. So
The WARMs
again, I
are.
think,
Oh, go ahead.
yeah. No, I was gonna say even though you're smaller, again, I think you just want to kind of follow the methodology as it is. But we
So
can.
the WARMs are, there's some subjectivity in the WARMs because
Yeah.
there's some different ways it can be calculated. You have assumptions about prepayment estimates and stuff going into the WARMs, but they're a historical mathematical calculation with some, you know, subjectivity in it. The WARMs then drive really the rest of the tool. You can't get a handle on what your reserve needs to be, your ACL under CECL, until you have a feel for what the remaining lives of your portfolio looks like, because that's kind of what the biggest concept is. What are the losses in my portfolio? What's the risk over the remaining lives of the assets? So we start by calculating WARMs under ACL. That drives the ACL calculations, but tying it back to, the only way we're tying it back to the old ALLL is just in that day one adjustment. And then if you have a huge shortfall or surplus, having some narrative that explains what, you know, where the big changes or difference is coming from. Paul?
Yeah, I think maybe there's just a confusion about there is regulatory relief in terms of being able to spread the impact on regulatory capital or net worth. And so that certainly is available to the institution, but you still have to calculate what the impact of the adoption of CECL is and make those general ledger adjustments. And then of course there is regulatory relief in terms of how that is quote unquote spread as an impact to total net worth.
Yeah, and I speak to that real quickly because that's a question I've been getting more frequently now. And the NCUA recently changed course on this. Initially, the NCUA said that if it looked like you were going to have a large day one shortfall, you could opt into a program where they would take that shortfall and sort of divide it by 12, separate it or spread it out over 12 quarters. Not as far as the balance sheet's concerned, like your schedule on your call report, but just for calculating your net worth ratio. So your net worth ratio would no longer be your current capital as it is on the balance sheet, divide as a percentage of the assets. It would be the net worth ratio would actually be adjusted to over 12 quarters, 1/12 in quarter one, all the way to 12/12 in quarter 12, based upon that day one adjustment. It was going to be an option. The NCUA changed course sort of kind of at the last minute and just said, you know what, we're just gonna, there's no opting into this. We're gonna do it for everybody. If you have a shortfall, your net worth ratio will be calculated such that for 12 quarters, we will phase in that day one shortfall.
Right. But
That's
you
helpful,
actually
Steve.
book the entry on your balance sheet itself.
Yes. Yep.
It's just that much like we have certain other adjustments between, I'll call it GAAP capital and regulatory capital. Sometimes we have different adjustments where we adjust between the regulatory capital ratios or calculation versus the actual balance sheet.
Mm-hmm. Mm-hmm. So it'll end up being in calculating your net worth ratio, you'll have like an add back of a certain amount, right? Where you're taking capital where you lost on day one and adding back portions of it to make the ratio look better for a period of time.
Perfect. All right. So Steve, again, we touched on this in your presentation last week or the week before. I can't even remember now. But just anything, again, our idea here, and I apologize for the confusion surrounding it, but our feeling is that we wanted to make sure and be clear to all of you that even though we had focused on the CECL or ACL impact as one big impact, moving forward, when we actually start reporting, we're going to want to establish 3 unique reserve accounts. So Steve, do you want to just kind of touch on that
Yes.
again?
Yeah. So initially in our tool, we were focusing last year on what's the overall impact of CECL on your balance sheet, right? On your institution. So we were looking at the impact on the loan portfolio, the impact on the securities portfolio, and the impact on the unfunded commitments portfolio, or whatever you want to call that. But the combination of those 3 isn't a number that you're reporting as one number on your call report. You'll report those as separate individual reserve accounts. One for the loan portfolio, that's your old ALLL, right? The reserve. One for the securities portfolio, which will be actually a new contra asset account on your Form 5300, which we'll show you on the next slide. And then on the other side of the balance sheet, on your liabilities, you'll have a brand new line item that's never been there before on the liabilities, which is establishing a new reserve for unfunded commitments. It will work differently. You won't have all these adjustments to it in the form of charge-offs and recoveries. It'll simply just be because you don't take losses on your unfunded commitments, right? We have to establish a reserve so we can estimate, we can kind of put a value on the risk that you might have in that portfolio, in those unfunded commitments. The only thing that will change that value is when you quarterly recalculate what that reserve needs to be on your current balance of unfunded commitments. It'll say, oh, it's a little bit higher now, or it's a little bit lower now. So you'll have a provision on your income statement, which will adjust that reserve account on the liabilities side of the balance sheet up or down a little bit. So first off, securities portfolio. That right there, you're going to have a line item 10 on the balance sheet for the 5300, allowance for credit losses on investment securities, which very few of you are actually going to have from a practical standpoint. I think we did a polling question last month, Sean, and 95% of you said that you just don't have any held to maturity securities that have real credit risk. Therefore, you're not going to have, you may establish a reserve on the GL, which I think Paul would say you probably should do, but it's probably going to be 0 for the foreseeable future for most of you. Next slide shows the loan portfolio. So that's the same spot. Well, it's right next to it, right? Item 16 is the old ALLL. You'll fill that out. Well, you will have filled that out forever until now. Now you will no longer be filling out line 16. You will now be filling out line 17. Which is, as you can see, a new account on the 5300. So that's where that goes. That's your old ALLL. And then finally, you have a new line item on the liability side. It's not a contra asset. It's just a straight up liability, right? Allowance for credit losses on off balance sheet credit exposures. So those are the 3 reserves that you will be, well, 2 probably establishing new, if there is any, and 1 you're just changing from the ALLL to the ACL. Next slide will show where those 3 things are on our tool. So the updated layout doesn't focus on adding those 3 into one big bucket, right? Because they're 3 separate accounts on your GL and on your call report. The first bucket, the big one, that's the old ALLL, the new ACL for your loans. That is on the loan portfolio summary, kind of the main page when you first log in. On the next slide, on the held to maturity securities tab, you have the calculation right there of what the reserve needs to be, if any, on the HTM security. This is going to be 0 for the vast majority of you. But again, we're just keeping it separate on the securities tab because we don't want to mix apples and oranges conceptually. And then third, on the unfunded commitments tab, we have right there, and this looks exactly as it always has. There's no change to this tab at all, really. We're just focusing on that's what we need for unfunded commitments for a reserve that's going to go into that brand new liability account on the call report.
Okay, so we've got a few questions. excuse me, and this one was probably a follow-up to the earlier conversation. Is a one-time adjustment to undivided earnings permissible?
It's demanded, right? It's required on day one. When you first do your first real CECL calculation, right? The calculation you do when you are now adopting CECL, you say, hey, my first calculation is more or less than my ALLL. The difference is a one-time balance sheet transfer. It doesn't go through the income statement. It's simply undivided earnings plus or minus reserve, now ACL reserve, plus or minus. Everything after that first adjustment is going to be monitoring and modifying that ACL over time in the exact same way that we had forever with the ALLL, right? Booking charge-offs, crediting charge-offs and recoveries, and then having a provision on the income statement that refills that bucket as necessary.
Exactly right. So we're making it as a one-time, and then of course, we're doing a phase-in for regulatory net worth.
Yep, that's right.
Great. I think, Paul, you may have answered this, but we'll just say it out loud so everybody can hear it. Are we allowed to opt out of using the allowance for unfunded commitments / investment securities?
So technically, no, you're not. You would have each one of those items are a component of the CECL pronouncement. So each one of those would require you to address them. We encourage all our clients to go ahead and set up the GL account so that it's there, even if there's a zero amount. So you would still have the GL, but like Steve mentioned before, many of you may have that GL account for HTM securities, but have no HTM securities that have credit risk that warrants a provision or a reserve. So you would just have that zero. Now, I will tell you that if some of you just say, I'm not going to do it, I'm going to put it all in the ACL, then you have to go to war with your examiners and auditors about materiality. But there is no provision within the guidance that allows you to simply say, I've got it all in one account. That would be carrying amounts that relate to another GL account in the wrong GL. So again, that's why I mentioned subject to materiality, but yeah, I would highly encourage you to set up the GL and carry zero if you need to, because examiners and auditors are going to be looking for that. And I would encourage you to go ahead and set up the GL and have it there. Even if you say, I have the GL, but it needs to have a zero balance.
Yeah, I think that's really good advice, Paul, because again, it by not setting it up, you almost, you set yourself up to be criticized, because then they're going to ask, did you even bother to do the evaluation, which you are required to do? So it just feels like you're just going to, you may feel like you're solving one problem, but you're likely going to create another problem. So, and this is probably unique to every institution, but the follow-up question was, what GL account number will we use for the unfunded commitment ACL? Probably
a new one in the liability section of the balance sheet. So you probably do not have a GL currently. You'll need to set one up in the liability section. So the new account for investments would be set up within the group of investment securities accounts. And as Steve mentioned, it would net against securities. The ACL is already an account you have, and you can continue to use that, or you could set up a new GL if you wanted to, but that is in the loan section as a contra asset. And then you will have a new liability section of the balance sheet set up, and that will be for the unfunded commitments.
Perfect. Thanks, Steve, or Paul, excuse me. The next question is, the question's from Steve. My third-party audit is as of 6/30/23. Do I need to adopt CECL now, or can I wait until 7/1/23? So I'm going to assume you're a calendar year, so we should adopt, as of 1/1. I think, maybe thinking about validations, you might be able to wait, but you're going to, if you were at 12/31, you're going to want to have adopted, as of 1/1. Paul, anything to clarify or add there?
Well, I was just my answer would be just to ask them, what is your corporate fiscal year? If you're a corporate fiscal year 12/31, then it has to be adopted 1/1. We still have a few institutions out there that have corporate fiscal years that end at June 30th, then it would be 7/1.
Great. Okay, that was helpful, Paul. Thank you. All right, so let's see.
Couple chats we got to go through. I think
Yeah,
we
I was
should
gonna
go through
say,
now.
so,
Yeah.
we're saying it's a liability account, but for general ledger purposes, is it set up as a contra asset account?
If
So
we're
again,
talking
I
about
think Peter was
unfunded
like,
commitments, I think.
Yeah,
Yeah.
yeah.
It's
So,
liability.
yeah, unfunded commitments, a liability.
Everything. Yeah. It
Securities,
has to be
contra
set up
asset.
on the liability side completely.
Yeah.
The next one.
All right, day one adjustment was done back in January. Are you saying we should go back and open month end for January? Or can we do it now prior to March 31st?
Depends on if you actually did, if you're saying you did a day one adjustment in January, from then on, you've already made the adjustment. You've adopted CECL, you have an ACL, you'll modify it the same way you had your ALLL in the past. If you're saying that it was supposed to be done in January, but can we go back now and backdate an entry to make the adjustment as of January? I think Paul would speak to that, but I think yes, right?
So typically we would see it dated as of 1/1, but of course, I'll put a caveat. You only issue quarterly call reports, right? So as long as it is dated within that current call report, you're theoretically okay, but that's not the best practice. The best practice, auditors and examiners are going to expect to see the transaction dated as of 1/1, regardless of when you actually calculate and book it. So normally we would backdate those entries, even if we were calculating them in the first couple of weeks of March, we're still going to backdate them. Up to you whether or not you need to reissue the board internal financials for the months. It's up to you. I think most boards understand it was something as of 1/1, but we probably didn't have the numbers until March 31. So
yeah, great point. The next question is that we open a liability GL for unfunded commitment shortfall. Is the expense GL still the same provision for loan losses?
Yeah, and let me show you actually, because this is different than and new for the presentation, just for credit unions. Can I share my screen for a second?
Yeah, I'll stop, Steve. You can take it.
All right. Let's see, share screen 3. So on your 5300 call report on the income statement, they do have them completely set. They have them separated and then added up. So all of your provisions, whether it's a provision for the loan portfolio, securities portfolio, or unfunded commitments, will flow through the total provision expense that's underneath your net interest income. However, you do have to calculate them separately and individually and then add them up. Because you can see here, there's 4 new line items there: loans, securities, both securities, off-balance sheet credit exposures, and then total. So they are added up together, but they all separated. So you do put them separately on there.
Yeah, perfect. Thanks, Steve. All right, so let me take back the screen and get my slides back up here. The next question we have, the follow-up on unfunded commitments. What do we report if they are unconditionally cancelable?
What do you report? You just note that they are unconditionally cancelable, and then they're netted out. You don't have to do any calc. You don't have to do, I'd say, unconditionally cancelable unfunded commitments are outside the scope of CECL. You don't have to make any adjustment for them. So you take your total amount, subtract out what you think is cancelable. The rest is your net. The net amount is what you have to deal with and guesstimate future potential losses on to establish the ACL.
Paul, I think this is a follow-up from Steve. He's a 6/30 fiscal year, so his question about being 7/1 as adoption is then okay, correct?
Yeah. Right.
Yeah.
Right.
Okay.
So the pronouncement applies on the first date of the new fiscal year. 12/31 is obviously the most common, so we talk about that the most, but it would be the first day of the next fiscal year.
Perfect. So Steve, yes, that would be 7/1. The next question is, do we need 3 separate provision expense accounts, or can we use just the one?
We need 3 because you have to fill out 3 on the call report.
Okay, I think, let me see, make sure I got everything caught up to date. Oh, no, I think we got a few more here. Hold on, let's see. Right. For prior acquisitions for non-credit impaired loans, is the appropriate action to combine related credit adjustments to the ACL?
Tell me
I
more
think-
about that question, I think.
I think,
that one's
yeah,
a
I
little
think,
bit
are you
dicey.
saying?
I'm not sure about the details on that.
Yeah, so I'm assuming we're suggesting that, are we lumping those into our overall portfolio and then applying our numbers? That's what if I'm reading that, that's what I would say. Yes.
And
what you're gonna do with
that is correct.
Yeah.
That is correct. Now, that can get extremely complicated if there was a credit mark applied so that you purchased a $100 loan for $75 because you have put a credit mark on them. Then we're putting a reserve on the $75, not on the $100. So that one, you need to be just very, very careful about how at the acquisition, those loans were brought onto your balance sheet. But once they're on the balance sheet, then we need to carry a reserve over the remaining life of that loan on the combined balance sheet. So you have to calculate on all of them, but
So for the purchase non-credit impaired or deteriorated, then yeah, make sure you're using the right.
Theoretically, there's not a credit mark on those. So I guess the question, I would just say, need to sit down with your external auditor and make sure that you're treating any acquired loans correctly, because you have to look back to the way they were booked at acquisition.
Awesome. Thank you, Paul. All right. So we did ask Paul just to kind of revisit some of the topics we had previously. Let me see. Okay. We got another question come in before we do that. What methods are available to validate our methodology or process? So first off, I'll say we have our SOC 1 available to you, but then Paul, do you want to kind of opine on what the credit union should do after that?
Sure. So we do have some slides in there about model validation, but keep in mind, the model itself has a SOC on it. So it says, regardless of what data or assumptions are put in, we will test the model to see that 2 + 2 always equals 4. There is an additional work that needs to be done to make sure that in your application of that model, that you are putting the correct data, your data, in correctly. In other words, it's being mapped correctly. So there's a data integrity. And then you have to look at the assumptions that you are using uniquely to your institution to make sure that they're the ones that are approved and are reasonable. And then the model works, which is covered by the SOC. And then what about the output? Is the output being sent to the proper governing committee or entity, and decisions are made on that? So you will have a parallel track. You'll ask the vendor, in this case, Quick Rate, please give me your SOC. You'll have to read that, make sure it doesn't have any exceptions. And then you'll have to have probably your internal auditor look at testing the data going in and the assumptions going in, and making sure that the output appears reasonable and is being reported correctly. So all of that together is validation. Part of it's your SOC report provided by the vendor. Part of it is an internal audit process. And then we're already, Sean, getting a lot of questions about back testing. Just like we back test our interest rate risk model, we're expecting that there will probably be a requirement for perhaps an annual back test, or maybe every 2 years, where you look at what were the losses predicted and what were the losses that actually occurred. What was the funding of my commitments? I predicted X level of funding of unfunded commitments. How much of those commitments did I actually fund? So there will be a review process, a back test that's needed, just to make sure that does the model appear to be working, because we're going to compare forecast to actual, probably on a periodic basis, annually or biannually. That's typically done by your internal auditor or an outside party doing that, so it's independent of the person running the CECL model.
Fantastic. Thank you, Paul. I don't know, since we're here, if you just want to touch on any of the bullet points here, just on internal controls and responsibilities for the credit union.
Sure. I mean, we're using modeling throughout the institution, right? We use it in stress testing, we use it in interest rate risk, we use it in various areas. This is no different. So at some point, you're going to have an auditor or examiner just ask questions. Who, is the model available to everybody in the institution? Anybody can play with it whenever they feel like it, or is it controlled? Do we have some controls about that? Input controls. What's the governing body that's looking at the review? Are they making the appropriate and timely based, decisions? Are they getting outputs to make a decision? So there's a role for the board or the audit or supervisory committee to play. There's a role for your internal auditor to play. And then there's a role for the model vendor, in this case, QuickRate, to play in terms of providing you all of the detail, how the model works, and also a SOC report. So that's an overview of modeling. Sean, quite honestly, that slide would apply to any model that we're doing within the institution, right?
Yes.
Asset anti-money laundering, for example, your alerts to cases and so forth. So this is an easy takeaway for everyone to sort of look at. Every place we use a model, these are the things we're going to be asked to look at.
Awesome. Thank you, Paul. Question came in. We have decided to use the NCUA pure data for prepayments and warms. Is this acceptable?
Go ahead, Paul.
Yep. Yes, there's no bright line of one source of the data to use. Many of the banking industry agencies are providing some level of support. So we're seeing that across the financial institution industry, if you will. And so you can use those. I will just tell you, as we get more and more evolved into the implementation, examiners are very likely to ask you, whatever industry data or peer data you're using, how does that compare to you? So is your institution got a similar risk profile? Is there something unusual about your mix of products and services? So you have to be a little bit careful. Just because it comes from a government agency does not mean it's just good as gold. You're going to have to think about, is this appropriate for my institution? Steve, do you agree with that?
Yeah, I do. I think I want to add a little color to that so everyone on the call knows what the question was referring to and where that data is. So the NCUA did a study, or had a third party do a study for small credit unions. So it was, the universe of institutions was credit unions under $100 million in total assets, but they were spread across the country. It was a good sized population of small-ish credit unions. And they looked at loan level data across the board, and they did calculations at the segment level. So for each segment, call report segment of the portfolio, which is nice, prepayment prepayment estimates, and or not estimates, but historical prepayment studies, as well as warm calculations for those institutions. So my first question would be, if you were using those prepayment assumptions, or those or some combination of those prepayment assumptions or warm values as your starting point, the question is, as Paul alluded to, are you under 100 million in assets? Are you a $12 million, credit union, and you're really on the low side of that? Or are you just around 100, or are you a $700 million credit union? And even if you're not within less than 100 million, that doesn't automatically make it inappropriate. Is there anything that means that the loan portfolio for a $100 million credit union is going to be different enough from a prepayment standpoint to your products to say that it's not appropriate? I wouldn't necessarily say so. So it's a great starting point. You may be asked to do more, or why you're not doing more. And if you're not doing more, why that is appropriate. But I think it's the best that we have from an industry availability standpoint. And it came from the NCUA, which is a good, decent place for it to come from. So yeah, I think it's a good starting point. And if you're not getting pushback on it, and you're a smallish credit union, that's where my starting point would be.
Great.
Sean, you often mention documentation. Obviously, as you go through that thought process, it is extremely helpful for you to take just a few minutes and maybe write a paragraph or two. This is what we thought about. Maybe we're a $300 million credit union. but we believe that our products and services would probably act in a similar way to a $100 million credit union. Therefore, we have decided to use this model. So having that thought process documented is extremely helpful in terms of sitting down with the examination team and having them ask you. You can provide that. It shows you've thought about it. It shows you've considered the difference, if you will, of that data set to your institution and your institution risk profile. So documentation makes a huge difference, and I would just don't overthink it. Doesn't need to be 33 pages. Honestly, it could be 1 or 2 paragraphs just saying, this is what we considered, and you know, we discuss that within the management team or the supervisory committee or whatever.
Yeah, that's fantastic, Paul. And again, I think it's just always a good rule of thumb is if you don't document it, then they assume you didn't do it. So Paul's point is spot on there.
Always cynical.
When is data available? If the quarter is already closed, do we need to restate the financials? So again, I'm not sure I'm completely following where we're going here. Steve, you got a thought?
I feel like generally it's a data lag question, but we get all the time, right? Well, we're asked to book a reserve as of 3/31, let's say it's April 1st and we're trying to close March 31st. We're trying to calculate a reserve as of March 31st. When we don't have the data as of March 31st that we would need the historical data to have no lag. We've always had lags. There's always been a timing differential between when you're calculating something and when the data is available that you're using to help you calculate it. Whether it's your own historical data, whether it's peer data, that's not a new concept. It's a little different under CECL. Some might argue it's more pronounced under CECL. I argue it's less pronounced because under CECL, we're looking at a longer term historical period. We're considering losses over a longer term period going forward, and we're probably evaluating losses historically over a longer term period in the past. So missing a few weeks or a month worth of the most recent peer data that leads up to the point in time that you're trying to estimate long-term historical trends, I think is probably somewhat less relevant. And I would also argue that if something is radically changed between, when you had data earlier in the year and the as of date of your calculation, that would probably be something that I would at least consider to be a change in current conditions. Because CECL is all about you look at your long-term historical results and then you modify them based upon Q factors. Q factors are changes in current and future conditions. So if the peer group fell off a cliff since the last peer group data that you have, or if your own loss experience got significantly higher or lower since the last date that you have these long-term trends, I would make a Q factor adjustment to say the environment is rapidly changing right now. That doesn't line up with our longer term historical stuff, which is a couple months old. Therefore, I'm making this adjustment. Paul, does that seem like a reasonable approach to you?
Yeah, I would just point out that we never close the books within the period. So, if we own a store, we have to wait till the end of the day to figure out what happened that day. So we always close the books for any organization, including financial institutions, typically the following month. So we're always looking back and saying, as of this date, what happened, and we're booking the related entries to that, and we're issuing the financials, generally speaking, on a quarterly basis, and usually within the first month of the subsequent quarter, we're done. Now, very fair to say, but what about peer analysis? I don't get those in the first month typically. So we're usually using, as Steve mentioned, a lag, and we're looking at the peer information as of probably the previous quarter to make a decision about this quarter's adequacy. We're booking that on the first week or so, or first couple weeks of the following month, and we're reporting it through to the regular board reporting and call reporting cycles. So like Steve mentioned, there's always a lag in preparing financial statements. We're always looking back to the previous period, in this case, previous quarter end. So
fantastic. That's great. The next is a question. Nowhere on the model is there a note about HTM securities. The ones held have no credit risk, and should be exempt from CECL, but I cannot put that in the model.
Yeah, you're right. In the tool, we have on the loan portfolio summary, we have a section for notes by loan segment for anything that's relevant to the loan portfolio. We have a separate section for notes in the unfunded commitments by segment. But since for the held to maturity securities, there's no administrative note box feature, so to speak, in the HTM securities tab. That's something, Sean, I think is an excellent, it hadn't been brought up before, but it's an excellent point. We might consider just putting a general single note box
Yeah.
in the HTM securities tab. So anything you want to build a narrative on for the, even if it's just, have no HTM securities, therefore no reserve amount, and have that as a note in there. We can certainly add that to our development list. So I think that's a good point.
I just add that I wouldn't put a note that says, I've decided there's no credit risk, therefore they're exempt. Technically, they're not exempt.
Right.
You've just evaluated them and determined that it's zero. So I wouldn't use the word exempt from CECL. I would rather say they are included in CECL in the scope. I've considered them, and there's no credit reserve required for those, so it could be zero.
Awesome. That's a good distinction, Paul. Thank you. Okay, so I'm just going to slide back a couple of slides since we, again, we had touched on this in a previous presentation by Paul about day one. That's here kind of, for your benefit, the ALLL policy. Do I need a new one? Paul had provided some points earlier. Paul, anything you want to just share about policies before we move on from this?
No, I mean, this is all fresh, and we're struggling to get through it all. So certainly you have to walk before you run. The first thing to do is, close the year end out, then go through your analysis of the CECL impact on day one. No question, the liability for unfunded commitments seems to be the one that gives the most angst and anxiety, because, it's a little bit different than what we've done before. We're trying to predict how many of our unfunded commitments will actually close and then apply a loss factor on that. That last point on that one, I would just point out that when you do finish that, we sort of all are looking forward to 23, and it's different now than it was perhaps back in November or December when you probably set your budgets. So you might want to revisit your targeted provision levels for 23 and 24, given all the things that have happened in the last few weeks. And certainly there's more credit risk now. So I would use the CECL implementation exercise to inform me about whether my budget amounts for 23 might need to be reconsidered. Again, we're not predicting the end of the world here, Sean, but we do acknowledge the fact that credit risk has gone up significantly over the last couple of weeks. And, a lot of residential loans, there's some adjustable loans that are going to go up. Housing values have gone up, so therefore hazard insurance is going up and taxes is going up. So poor borrowers are being hit with a rate increase as well as an increase in escrow. There's a lot of changes going on in auto valuation right now. Obviously, interest rates for new loans is going up, which may push some borrowers that need funding into a little bit more of a risky position. So I would certainly encourage folks, since they have so much time on their hands, Sean, right now, I would just perhaps before you put this folder away, stop for a moment and say, are my budget amounts for 23 still appropriate, or do I need to adjust them one way or the other?
Yeah, that's a great point, Paul. And I think, again, just kind of brings into light this the whole Q factor conversation, right? You can feel directionally that there is more credit risk. Maybe it's not showing up completely in all the numbers, but we can sense that things look a lot different or feel different than they did just even a few months ago. Regarding the policy, anything, again, you shared this with everybody at the end of the year, but anything you want to add here that you've seen since then that is of note?
Yeah, I'm sorry, I meant to add, because you do have to walk before you run, I would not be overly worried about trying to get this policy done. Like, there is no gun to your head, if you will. You're still learning how to implement CECL and report it, I would say that probably during this year, it'd be helpful to have a draft policy, perhaps a pretty simple policy in place. You can always add to it as we evolve and so forth, but there is no specific requirement to have a written policy in place by a certain date. I would just suggest that you would at least have a draft or a rough draft in the first quarter based on what you went through, and then continue to revise and enhance that over the year. But I do appreciate that we're asking everybody to do an awful lot at once. So
Yeah, that's really good advice. Thank you.
Sean, do
All
we
right,
want to point out where that is on the tool?
Yeah.
Give me a second to pull it up. You can go on to the next one. I'll pull that up so everyone can see exactly where those sample ones that we have available live.
All right. Actually, Paul, this is going back to the modeling. I forgot this slide was here when we were talking about it before, but I think these were just some reminders that you had regarding the testing that maybe you can just touch on real quick.
Well, again, in the model validation, part of the total model validation is the vendor provided SOC report. And just wanted to remind everybody that that's always a backward looking report. So typically it's done as of a certain date, and it takes a while for the firm doing that report to issue it. So it's not going to be, as of 3/31 being delivered on April 1st type thing. There's a background, but you want to look at it, and you specifically want to look at the user controls. Those are the things you're responsible for. And that's really what's the expectation for the SOC type report. And then periodically, as I mentioned, back testing, you can use another model, a simplified model, to sort of see, are the results similar both ways? I will tell you that this does not necessarily have to be done once a year. So it says perhaps once a year, but you could do a model validation every 2 years or every time you change models, but I wouldn't go too far. I wouldn't go too long between them.
Great. Thank you, Paul. Steve, do you want the screen then?
Yep, just momentarily. So in our tool, the CECLSolver resources button, when we click on that, in addition to a lot of the other ones and the SOC 1 report right there, we've got two policy template samples. They're Word docs. So if you click on it, it'll download right there. It'll do this. It'll download right there. And when you open it up, it'll look like that.
Yeah, so you can customize it to yourself. You can edit it. So we, again, just wanted to kind of move you from a blank page. And so again,
Yep.
A little bit out of what we normally would do, but we had enough institutions ask for our help. Paul was kind enough to kind of give us some of his thoughts as well. So again, I think it's a pretty good starting point for everybody to use.
Sean, I love it when you remind us not to overthink things too. So, I would start with a simple policy and let it evolve over time. It's nice to have one, rather than to have the perfect one. It's good to have one. So
there you go. Amen. And I think in the December call you had mentioned, right, this is an opportunity then to allow your third party to potentially critique it and add something, and that's kind of an easy
absolutely
give to them.
Absolutely.
Anything here, Paul? I mean, you kind of touched on all these, but just,
I think we did.
Yeah. Finally, we're getting closer to the end here, but just now, again, want to remind everybody, if you want to ask any questions, we've got some coming in here. Thank you all very much for the kind words for attending today. Let's see what else we've got here. All right. I think we're doing pretty good.
I had anything on my
check to see if I missed anything,
list.
But just a reminder, we will be back in April with another edition of Coffee Talk. We'll certainly, again, thank you for your feedback and attendance today. We will work to shape the future ones the rest of the year to, again, kind of address concerns or, areas where we feel like, more guidance or help can be provided. So we'll work with that. But I think everybody's just thanking us, which I certainly
Yeah, I
appreciate.
had one more thought, Sean, if
Yeah.
we've got a minute, this would be
Yeah.
specifically to get Paul's take on this. Since we haven't really discussed it too much today, is the unallocated reserve.
Oh, yeah. Yeah.
I think it's a good topic, and I think hearing from, so Paul, if you could shed a little bit of light on whether it's appropriate, what you've heard, and just kind of give us a little background on that.
Sure. We never had a pronouncement that allowed unallocated. We just always had a slight difference between under the incurred method. We might have a little bit more in the GL than we had in the required reserve. And as long as it was not a huge difference, we deemed it immaterial. In the academic revisit of CECL, we repeated the fact that under GAAP, there is no concept of just a cookie jar or unallocated reserve. However, it's certainly expected somewhat that occasionally the financial institution may have a little bit more or a little bit less on their GL than what the model requires. Usually we never hit a little bit less because people just automatically make the reserve go to that. But if you had a little bit more than that, as long as it's okay with your management team and as long as it's okay with your auditor, again, it has to be immaterial. So there was no change in CECL. Under the incurred method, there wasn't a provision for unallocated. We just lived with it like we do on a variety of things in the GL. Sometimes the supporting documentation may be slightly different than the GL, and we say it's not material enough to make an adjustment, and that's okay. That's all the unallocated is. The only trouble you'll get into is if you think that you can have a cool cookie jar called unallocated and build reserves that have no support for it, you will get in trouble. Unallocated
as you should have in
just
the
the
past.
difference.
So the concept hasn't changed.
The concept really hasn't changed. It's just that we've lived with the incurred method for so long. It sort of became like sort of acceptable that there would be a little bit of a difference. And when CECL was proposed by FASB and gone through academically, there really isn't a provision or a concept of unallocated. It's simply the difference between the amount you actually have on your GL and the amount that is in the model result. And as long as that difference is immaterial, it's okay. But I would warn you, please check with your auditors because different auditors have different feelings about that. So their sense of materiality may be very, very different than mine or someone else's.
Yeah, absolutely. Great point. We did get one final question. I think, is it absolutely necessary to have 3 separate expense accounts for ACL?
I'd say yes, because we have 3 separate line items for it on the call report now. So on the income statement for your call report for March 31st, it's going to ask you to have a provision expense for all 3 of them separately, and then the system will add them up to be another line item, which is the total provision. So you can't fill out the call report completely without having three separate expense items.
Yes, Steve, I would add that in the old days, we could have just had them on one and we had a separate little Excel sheet and we would type or write those numbers on the call report, but virtually all of your call reports now are being mapped directly from GL. And so if you map your GL into the call report to file, it will not know what to do if there's only one number to put in. So I'm assuming everyone is using some type of automation in their call report preparation. So because of that, you have to have a GL or some mapping of GLs that would go to every line in a call report. So I agree with you, Steve, but I don't know what benefit you would have. You would work a lot harder by having one GL account than 3.
Yeah, you have to manage the reserves separately. So you have to know what those 3 items are so that you can properly have the balance sheet filled out. So since you have to know what those 3 are anyway, you've already done the work. You plug them into the income statement separately, and
And I would just add, it exposes you to the suggestion that you didn't evaluate those things if you didn't establish the GL. So you just kind of solve one problem and invite another one where the third party, you say, well, you didn't even set up an account. Did you actually evaluate those for whether a reserve is necessary? So I just don't know that you're going to gain anything by not doing it, even if there's no entries to be made.
Yeah, especially just considering the fact that call report preparation now is at least a portion of it is automated. So it's all coming from GL. So
yeah, absolutely. All right. Well, thanks very much to Paul Allen for joining us today. Certainly to Steve as well. Any final comments before we let everybody go?
Nope.
Enjoyed the conversation very much.
Well, Paul, thanks again for joining us. Our largest attendances are always when you're here, so thank you very much. Thanks to all of you for attending. We'll be back again next month, April 21st, as you can see here. Good luck with your quarter end coming up, and if there's anything we can do in the interim, just certainly reach out to Jason, David, or our team here at Quick Rate, and we will try to get your questions answered as quickly as we possibly can. So without further ado, thank you very much. Have a great weekend, and we'll see you next month.
Thanks, everyone.
See you, everybody.
See you.
All right, bye.